So I hope you're all sort of keeping well and safe. This is our very first webinar, so we hope it all goes well today. And as usual, we'll welcome any feedback from you as it goes along. Going to sort of start going through a few points with you from here. So just getting the IT working correctly. So overview of today. First thing for sort of microphones and cameras. Don't worry, we can't hear what you're saying and we are able to see you. You're just going to be able to see myself, Sarah and Shane and the slides that we're presenting today. The agenda and timings for today. We're going to go through spending 10 or 15 minutes explaining a few of the things that we've done at Berry Note recently. And then we're going to pass on to Shane, who's going to spend about 45 minutes giving an update on the investments and what's happened with them. During that, please feel free to ask questions. We've had a number of good questions so far, so thank you very much. But you'll notice on your options for the Zoom that there is a Q&A box. So if you've got any additional questions to ask as you go along, please type away and we'll pick them up. And when it's the most appropriate time to answer them, we'll pass that to either myself, Sarah, or Shane to answer from there. That was the next bit about questions. And then after the event, we are hoping to do a recording of the event. So I have pressed record. So that's a good part of it from there. And if it all goes well, it'll be available for you to see afterwards. We will also be asking you for some feedback, and Sarah will explain that more towards the end of the presentation. But moving on, probably one of the most important things that we wanted to update you about are financial planning meetings. These are the most important things that we do with you, and we really have missed seeing you face to face over the last 12 months. At the moment, we're still doing Zoom meetings, and we expect that to continue for the next few weeks. And then steadily, as we come further out of the lockdowns, we're hoping to be able to start doing more face-to-face meetings in a sort of COVID secure manner. If you feel at the moment that you really would like a face-to-face meeting and that's necessary to discuss your financial planning as it is, then do let us know and we'll see what we can do to arrange that. But if not, doing them over Zoom seems to have worked really well for clients so far. Just wanted to also give you an update about our personal finance portal. And I know a lot of you are registered and using this quite well. We've got nearly 70% of our clients actively using the portal now. Just remembering when you go in there, it's worthwhile setting up the two-factor authentication that makes it more secure when you log on, because it means it's not just your username and password that's needed, but access to your phone or computer and the special code that's generated. We also find that two-factor authentication is useful on a lot of other sites, such as Amazon and banking, to protect you there. So you can use the same authentication in different ways. People are also using our PFP to view their portfolio. So most of the investments and pensions that we have recommended update on a daily basis. So you can log on and see what they're doing. We've also got settings available where you can see yours and your spouse's or partner's portal valuations all from one login, which makes it easier for you. People are also going through open banking where you can securely link your online banking to come through and be viewed in the portal. You can't do any transactions on it, but it gives you one clear picture of all the investments you've got in bank accounts, pensions, and normal investments. And secure messaging is working very well, where you can send messages to us, the whole team can see them. It's more secure than having the data in your emails, so it's a better way of using it. And you can make attachments to a secure message just like you would do to an email. So there's no need for you to put them in a separate document part. You can just drag them into the message and it'll be sent across to us. And finally, DocuSign is a big thing we've used over the last 12 months, and we're looking to use it more and more. This is where the paperwork that you may need to sign, we're able to send that to you electronically over the personal finance portal. And with a couple of clicks of your mouse, you can sign it and send it back. That's reducing the need for us to sort of post things out, time waiting for it to come back in the post. And a lot of transactions now, we've been able to do that on the same day, where before it took us 3 or 4 days while we were waiting for the post. So another big benefit of using the portal is being able to get transactions done a lot quicker for you. So I hope you find that useful. And if you have any questions at all about the personal finance portal and how to use it, then just give us a ring or drop us a message. One of the team will be happy to help you go through and explain it. Just wanted to give you a bit of an update as well, what's been happening with the team. So Anya joined us nearly a year ago, straight from having done her A-levels. Anya's been doing a great job on an apprenticeship program that she is completing with us. And the external people running the apprenticeship have been full of praise, as have Anya's team members. You probably heard from Anya when you're arranging your meeting, because Anya's helping arrange all the meetings and corresponding from there. And she's often answering the phone. You've probably spoken to on the phone already. We've also got Dan that's joined us and will shortly become a financial planner with us. Dan has been sat in a lot of meetings over Zoom, so you've probably come across him already. He's become highly qualified already. He's got enough qualifications to become chartered. He just needs a little bit more time in the profession. We call him Dan the exam man, because he's been prolific in getting through his exams and loves studying and all the work involved in doing the exams. So Dan's been really good in helping in sort of technical support and getting involved in more technical queries. We've also got Sarah. And Sarah, in the last few months, has finally qualified to get her photo on the parents' wall. And I'll tell you a little bit more about that in a moment. But basically, Sarah's been working hard on her exams, and she's now become a chartered financial planner, which is about the highest qualification you can get as a financial planner. So really well done to Sarah for what she's achieved here. By achieving the Chartered Financial Planner designation, it's classed as a level 6, equivalent to a first degree. And on her father's wall, he has a photograph of all the children when they pass their degree. And as you can see, he's had a little sticker there waiting for Sarah to get her photo on there. So now she's qualified for the Chartered Award. When the COVID restrictions are lifted, she'll be getting a photo taken and her picture will be on the screen. Not quite sure how I ended up getting on that picture as well. I managed to get on there, I think in lieu of Sarah some time ago. But the other great stuff for Sarah is she's also continued from there and done her Certified Financial Planner qualification, which is actually level 7 and the equivalent to a master's degree. So she's actually overtaken 2 of her brothers now as well. So well done, Sarah. We've also got Rachel, who's joined the team to help in business support. She's got level 3 qualification in the Association of Accounting Technicians, and is helping train and develop and improve the team members and their qualifications and helping them deliver the great service to you. Also, just wanted to update you a couple of other things that we're doing. We've launched this year the Berry Note Graduate Scheme, and we're going through a round of interviews with people at the moment. And it's been quite amazing that we've had over 30 applicants for the graduate scheme already. So hopefully we'll be having a new member of staff for you to be meeting shortly when you're turning up for your meetings face to face, or they may also be involved in some of the Zoom meetings as well. But apart from that, we've also taken on to sponsor somebody through a career change to get into financial services, because a lot of people aren't finding the opportunity to get into financial services. And as a small firm, there's only so many people we can help and employ. But we've actually sponsored the training for somebody over a 2-year period that at the moment works outside of the industry, with a view of helping them get their qualifications and be available to join a firm in the UK sometime in the future. Moving on, you'll be pleased to hear you've almost heard the last of me for the moment. I also wanted to share that we've been very proud to have won 2 more awards recently. We won the New Model Advisor Firm of the North, which actually is for the 3rd year running. and I'm really pleased with the team and all they've done to achieve that. And then we won a national award of the Tax Efficient Advisor of the Year for Professional Advisor, which is based around all our knowledge of the different ways of being tax efficient in investments, especially around VCT and EIS investments and business property relief to reduce inheritance tax. So that was an amazing award to win on a national basis. But now really getting ready to move over to the main event. We've got Shane, who some of you will have met at previous face-to-face client events that we've done. Shane's the Chief Investment Officer for Beaufort Investments, and he's going to give an update today on what's been happening with markets recently, the performance both recently and long-term on the Beaufort portfolios, and what they think is going to happen over the next few months for investments. Shane, as you know, has been running the investments for over 15 years, and he's going to provide quite a lot of information that I think you'll find very useful. If you've got any questions at all about what Shane is saying, then just put it in the message bit and let us know, and we'll look to answer those as we go through the presentation. And if not, we'll bring them all up at the end to go through and answer what we can. Any that we don't get time to answer today, we will look to answer to you directly afterwards. So with no further ado, I'm going to stop sharing mine and hand you over to Shane.
Thank you, Andrew. Great introduction, and this is where I try and make sure the IT is working. There we go. So welcome everyone. As Andrew said, the agenda for my part today will be review of the current macro environment, what we've sort of just had more recently, and then how we performed in 2020, because obviously it was a very, very unusual year. I was going to say unprecedented, but I think we've used that word up pretty much throughout the rest of 2020. And then how this year has started. So we've already had the Q1 in 2021, but it's not all about short-term performance. It's about longer-term performance and fulfilling those longer-term goals. So we'll go through the long-term performance for you as well there. Then finally, our outlook, what we think is going to happen primarily for the rest of the year, but sort of beyond as well. Then there's some time for some Q&A. We've already had 3 really good questions come through already, but if you've got any other questions, please don't hesitate to send them through. What I won't be talking about, you'll be thankful, is Donald Trump, China, or Brexit. So they've gone now, effectively. Well, the main concerns we had have gone for those. And if you look very carefully on that map of Europe, I've taken out UK. This is our marketing team, trying to keep up with Berry & Oak with the amount of awards they win, which is phenomenal. So well done, Andrew, Sarah, and the rest of the team. Our most recent award came at the end of the year, which was winner of the best specialist multi-asset group. So we're really pleased about that. More often than not, it's not just the award, as Andrew will know, it's the judges' comments, and we're really pleased. They think our clarity and explanations of our communications are top. So thank you for the judges on that one. So review of the current macro environment. Now, it's been a while since talking to Berry & Oak clients. I think the last time was at the castle with electricity. The previous one we didn't have electricity, but for probably the last 12 months, the environment has been really similar, and it's about having government fiscal stimulus and central bank monetary stimulus, and they've kept this holding pattern throughout COVID, and they will continue to do so until COVID has been, I'm not going to say eradicated, but defeated. I think we're all aware that we'll probably have to live with the after effects of COVID for a considerable time, but it's about making sure that A, people are going to be safe and not die unnecessarily, B, that the hospitals and the health systems aren't overloaded, and C, we can actually reduce any lockdown measures and go about whatever new normal will be in this new environment. And in order to do that, we need to make sure that both the monetary and fiscal stimulus systems are still going to be in place. If you think back to 2008, we had the global financial crisis, and that was an inflection point where we were worried about the entirety of the financial system. And that's where you saw huge measures put in place to make sure the financial system stayed robust. Now, this time around, a very different crisis, but the financial system is still solid. There was no concern about it falling over, but it still needs liquidity fed into the system. And it also needs to make sure that the other side of that, make sure on the financial system, the other side is the consumer, you and I, and making sure there's enough support there. So it's trying to keep economic activity as high as possible, but also try and keep unemployment as low as possible as well, and keep people reassured about the future. So after the election, which was dragged out, Joe Biden was announced winner of the presidential election, and he immediately put through his American Rescue Plan. Now that came through at 1.9 trillion US dollars. And it's about another level of stimulus to make sure that businesses and healthcare and everything else is made sure it doesn't fall over. There was also a stimulus element to that. You see one of the largest bars, $410 billion worth of stimulus checks. So that's another series of checks being given to every eligible adult in the US. They get $1,400. Now, some of that will go down towards paying off debt. We've seen a lot of that. Some of that will go to investing, and you've seen a big flurry in investing. We've had one question about the level of value in the stock market at the moment, and we'll come across that in a moment. But some will also go towards savings, and they'll have this pent-up demand that I'll come on to later as well. But you can see these are huge numbers involved. On top of that, there's a 2 trillion plan. Currently, the Biden's infrastructure plan that's going through Congress, and it would definitely not look like this at the end, because there'll be different people putting and adding different things to this bill. But there's going to be another rollout of infrastructure. The US in particular, its highways, its roads, its bridges, its railways do need a lot of upkeep and some replacement. But it's not just sort of trucks and trains and planes. It's things like high-speed broadband. There's, for what you'd consider probably, one of the most advanced countries in the world, there are big pockets of areas in the US that don't have what we would consider acceptable broadband. During the first lockdown, there was McDonald's and Starbucks kids. Now, what do I mean by that? It was parents driving their children to the car parks of McDonald's and Starbucks to click onto their Wi-Fi, because the Wi-Fi at home wasn't suitable. And this was in New York. So a lot of infrastructure needs to be rebuilt. Not just the US. Obviously, the numbers are the largest when we talk about the US, but our own Chancellor, Rishi Sunak, in his budget last month, announced a 65 billion 2-year boost to tackle the pandemic. And it's very much the solution is spend now, make sure we recover from this pandemic, and then afterwards, you'll see the ramifications of increases in tax. Probably more at the corporate level rather than the individual. So that's the one side, that's the fiscal side. On the monetary side, they're more involved in making sure that the financial system still works, there's liquidity, and it doesn't grind to a halt like it did in the global financial crisis. Here we have Jerome Powell. He's chair of the Federal Reserve, the largest central bank in the world, and it's in the US. And what we have here is it's a promise of making sure that the current environment is going to be around for a long time. And what you have here, each dot on this dot plot represents the estimate from the committee who set interest rates at the US central bank on where they think interest rates will be at the end of the year. And you can see here at the end of 2021, everyone expects interest rates to be where they are, which is roughly about 0.25%. At the end of 2022, the majority still says they be where they are. And even at the end of 2023, the majority still think they're going to be where they are. Now, longer term, they don't specify what longer term is. You're looking at a rough interest rate of 2.5%, which when you think back to the last interest rate rising cycle, which went through 2016, 17 and finished in 2018, they were trying to get near a 3.5%. So you've seen already 100 basis point drop from that estimate. Now, these were the indications back in December. They had another meeting in March, and pretty much the dots have stayed the same, because what you had throughout the first quarter of this year was a sort of a tug of war between the central banks and the markets. Markets expecting interest rates to rise a bit quicker based on the spectre of inflation, and we'll come to inflation later. They were sort of trying to see if the Federal Reserve would blink. But what the Federal Reserve has done, and all the central banks actually around the world have said, is nope, we're going to keep this easy monetary policy condition in place until we're out of the woods. And it's not just keeping interest rates low, it's about making sure there's enough pledges of money in the system. And you can see here last year the amount of billions pledged towards quantitative easing purchases. This is buying assets that no one else wants to buy and keeping liquidity going. And the most important thing for us was, you can see like that lovely teal color, that was the amount of stimulus as a percentage of global growth was much quicker and higher than it was for both the global financial crisis and the tech bubble. So that was central banks learning from the mistakes, or just the lessons from the past. They had to make sure it was done quicker, larger, and was going to last for a longer period of time. Most importantly as well here, though, you can see the amount of money already pledged into the system. Japan has been combating this for a lot longer. But you can see here, United States and Europe still got a lot of dry powder. And this is the chart from the Federal Reserve. And what you can see here is the grey lines at the top. That's the amount that's been pledged, the amount they have put aside for combating corona. You can see the teal bars is how much they've had to use. So a lot of dry powder, a lot of things still in the system. So it should give a lot of reassurance to both markets and investors. And it's the same with the European Central Bank. In their last meeting, they've actually increased the amount of stimulus they're doing. They're probably one of the worst areas for both combating the COVID crisis, in both terms of stimulus and in the vaccine rollout as well. So the backdrop's pretty similar for the last 12 months, but how did we perform over that very difficult year? We're going to look at the model portfolios, both the active and the passive, throughout the calendar year of 2020. And you can see here our active portfolios have done extremely well. First and foremost, positive returns, which based at the level at the end of March, when the markets had dropped 45%, we were very pleased at. And you can see as you've taken more risk, you get a consummate level of return for that. And similar picture for passive as well, although slightly underperforming active over this calendar year. And you would expect during this period that, just had a question come in. I will cover that off. I've got a Bitcoin section a bit later, so thank you for that. During periods of high volatility, you would expect active to outperform, and we've seen that over the last sort of 12 to 18 months. We use the ARC benchmarks for the returns, and you can see here for sterling cautious, that is where we measure our portfolios 1 and 2, slightly underperformed, but we tend to have a more cautious approach than the industry as a whole. For portfolios 3 and 4, that's measured against balanced, and we've outperformed there, which was really pleasing. For portfolios 5 and 6, it's against the ARC steady growth portfolio, and significant outperformance there. And finally, for portfolio 7 to 10, it's against equity risk, and again, outperformance there. What I would draw your attention to, though, is whether it was the cautious, the balanced, the steady risk, steady growth, or the equity risk, the benchmark returns were really similar. There was hardly any dispersion there. That just shows you how difficult a year it was for the industry as a whole, and we're very pleased with how we performed. But looking back of how we performed, we're going to look at portfolios 5 and 8, so in the middle and towards the higher risk portfolios. Where did 2020 sit in relation to previous years? And even though I looked very similar to that photograph, even probably got a similar shirt on as well that Andrew showed, we've got 16 years worth of data now on the active portfolios. And what you can see here is every quarter for those 16 years. And most importantly, there's a lot more positive quarters than negative. It's roughly 70% positive and 30% negative. So that's a very good ratio when the industry as a whole gets very excited when it's just over 50-50. But where did the quarters land for 2020? Probably no surprise to see that Q1 of 2020 was the worst quarter we have seen. Worse than the global financial crisis, worse than the sovereign crisis back in 2012. For all the portfolios, it's either the worst or the second worst portfolio we've had. So, you know, that just shows you the extent. However, we didn't panic. We made some changes at the bottom, bringing in things like high yield at a really low price, and also increasing our equity weighting, which meant the second quarter was one of the best. Now, for most portfolios, it's either the best or the second best quarter there. So another reason for not making knee-jerk reactions and having a longer term investment period. If you decided to have come out at the bottom, you wouldn't have had the benefit of that excellent return. And as you can see in 2020, it was positive overall. Q3 was what we'd call one of our bread and butter quarters, you know, in that range of roughly 3.5–4%, which will take every day of the week. Thank you very much. And the last quarter was again in our top 10. So overall, apart from Q1, it was a very, very good year. And it's a very similar picture for portfolio 8. Obviously has a higher weighting, so it has higher returns. But you can see here again, worst quarter followed by the best quarter, followed by a steady quarter, followed by another top 10. So that's how 2020 panned out. So that's all in the past. How have we started in 2021? And what you have here is our active model portfolios for the first 3 months of the year. And you can see a sort of, a pattern emerging. You'll see this in the enhanced passive as well, where the year started very well, gets to the top and then rolls over, and February starts again like this and then rolls over, and March started well again, started to roll over, but then actually continued an upward trajectory. So we'll call this sort of the grand old Duke of York. He gets to the top and marches down again. Now, what were the reasons for both of these sort of markedly down periods in the end of the month? And it was based on the markets expecting central banks to give forward guidance that interest rates would be raised quicker than the expectations, and expecting the heads of the central banks, Jerome Powell, to come out and admit, yes, we'll probably raise interest rates quicker because markets have certainly recovered quite well. Now, what changed in that March period, why it didn't drop down and it continued to go up, was, if you remember those dot plots, they are on the 16th of March. And after he came out there and reiterated once again, formally in one of their, they have 8 meetings a year, and this was the first one of the year, formally announcing, yes, we are still going to have low interest rates for the foreseeable future. We're going to make sure we've got out of COVID before we think of rising, and that's why you see it's recovered from there as well. Now, slightly negative performance for the lower risk portfolios, because what you've had for the first 3 months of the year is arguably probably the best period for equities, and we've had something like the first 5 months, the last 5 months, so November, December, January, February, and March, bringing in a record amount of inflows that eclipses the previous 12 years. So a huge amount of money flowing into equities, based on knowing that the government and the central banks and their fiscal stimulus is really pretty much underwriting the returns for this year. On top of that, you've probably had the worst period for bonds in the last couple of decades, as interest rates are so low, and there's a sort of an expectation of a spike in inflation, but a transitory one. We don't expect it to be around for a long time, and inflation is one of the last things I'll talk about at the end. That's why bonds have done particularly well. And again, very similar picture to enhanced passive, that same pattern of going up and coming down, going up and coming down. That's the short-term performance, but as we always say, it's about long-term performance, albeit it's a quilt sewn together of short-term periods. And rather than show you the since launch performance of 16 years and of 8 years for the enhanced passive, we're going to show you both of those over 1, 3, and 5, because we're aware that not everyone will have been invested since we launched, and it's really important to show a picture of a 1 year, 3 year, and 5 years. So here we have the active model portfolios over 1 year. Probably couldn't pick the better period because it's like from the bottom of the market all the way through the top, and some really good performance. And you can see here, very similar to the 2020 picture. More risk you take, the more of your return. Now, what we'd like to do is great, it's really important to get absolute return and absolute value, but it's equally important to show values being added, and we like to measure in cash, inflation, and as a bellwether, the FTSE 100. So here you have is that line for cash, and you can see all the portfolios beat cash over the last year and inflation, and actually portfolios 5 and above beat the FTSE 100. FTSE 100 has done a little bit better in 2021, but for 2020, it was down 12%. And compare that to our portfolios that were all positive over that period as well. Bring it forward to 3 years, and you can see here that markedly drop for COVID is obvious. And the previous drop there was at the end of 2018, when the Federal Reserve was arguably trying to raise interest rates too quickly, and the market reacted poorly to that. But we recovered from that. So a very interesting period that captures all of that. But over that 3-year period, all the portfolios making positive returns. Add in the metrics as well, and you can see here all the portfolios beating cash and inflation, and nearly beating the FTSE 100 as well. Portfolio 1 slightly underperforming the FTSE 100, but gosh, that is our lowest risk portfolio. As you can see, added considerable value over this period. And finally, 5 years, which is our minimum holding period, would suggest for clients. And again, a lovely pattern of strong positive performance. And even over this 5-year period, you can see if someone hadn't been invested over 5 years, the COVID drop didn't take them into negative, which was lovely. And again, portfolios 4 and above beating all the metrics. All the portfolios beating cash. And as you would expect, would always expect portfolio 1 to roughly just underperform inflation, because you do need some real assets in there to beat inflation and continue your purchasing power. That's our active portfolios, now our enhanced passive. A very similar picture, slightly lower returns than active over that same period, but still good solid returns. And a very similar picture for showing you adding value over cash, inflation, and the FTSE 100. That similar picture for 3 years as well, but again, over that 3-year period, still having a positive return. And the same as active, all the portfolios beating both cash, inflation, and FTSE 100. And finally, 5 years. Very similar pattern as well. You can see the big downturns for the COVID and for the kicker we had at the end of 2018, as I've just alluded to as well. And here, portfolios 4 and above as well, beating FTSE 100, and all the portfolios beating inflation and cash as well. So short term and longer term, very pleased with our performance. One of the key metrics we look at is since launch, and this is since launch of the active portfolios, how often has that return been positive? So remember the chart showing you all the quarters. And you can see here, 71% of the time, we provide you with a positive return. So, 3 out of the 4 quarters of the year should be good for you. But the longer you have an investment horizon, the better your probability of getting a positive return. So over 5 years, you've got a 99% probability having a positive return. Now, that's our data. Goldman Sachs have done a very similar piece of work. And for them, their 1 year data was 79%, bang on the same as us. We have 79% return. But their 5-year data is only 89% probability, whereas it was almost 100. For them, you've got to get to 15 years. And this is the market as a whole before you're almost guaranteed a positive return. So we're doing a lot better than the overall market, which is important. So that covers off the current macro environment and how we've performed over that period. We're going to look at the outlook now, particularly for the rest of 2021. Before we get to that, this is where the Bitcoin question can come in. And oh, let me go backwards. I just need to find there we are. How do you view the growth of digital currencies as Bitcoin affecting investment in traditional markets? That is a great question. It's very rare that our regulator comes out and actually preempts warnings for particular things. But beginning of the year, the FCA saw to it to offer a guidance on crypto assets such as Bitcoin. And most importantly for us is, the warning that if consumers invest in these types of products, they should be prepared to lose all of their money. Now, we view Bitcoin and the like as speculative investments, purely because it is too volatile and it is not based around any real fundamental reasoning why it goes up and down. If a owner of an electric car company can tweet that they've put Bitcoin on the balance sheet and it increases Bitcoin overnight by 40%, that is not an asset class that we would favor within our remit of sensible, plain vanilla, softly. If people want to invest in it, I've got no doubt against that. Now, will it harm traditional markets? That is open for question. What it has arguably done at the moment, you've seen a big rise in Bitcoin and cryptocurrencies on the back of potential rise of inflation. Now, typically, the safe haven in times of predicted higher inflation would be gold. And what we've seen is the inflows going into Bitcoin and Dogecoin and all the others, taking what arguably probably would have gone into gold. So the flows into gold have been considerably reduced, whereas the flows going into the cryptocurrencies have increased. Now, whether that's going to end up being a permanent swap, we don't know. And it's, back in 2017, we saw a higher Bitcoin and it dropped dramatically. Who knows where it's going to go this period? I think we need to get out of this current holding pattern with fiscal and monetary stimulus and get back to some sort of level of normality, some sort of level of rising interest rates, that stimulus starting coming back, and then we can see how these assets behave in more normal environments. But that's a really good question. Mind the gap. This is what our outlook's about. Mind the gap. What do I mean? It's about this virtuous circle of trying to close the economic activity gap, and it's about making sure there's a successful vaccine rollout, which will then allow the population to gain immunity. More people that have immunity will then be more willing to engage in economic activity, going to the shops, spending their money, hopefully soon, going to restaurants inside and having meals. Now, that increases as that economic recovery increases. It gives more people consumer confidence. As more people get immune, economic activity increases and the gap starts to close. So as long as we have this virtuous circle, it looks very favorable for that environment. And in that, I can include the UK and include the US. On the flip side, if you don't have a good vaccine rollout, if you don't have economic activity increasing and lockdowns, restrictions being lowered, it almost works in the opposite. So you have higher restrictions. Maybe people aren't willing to get the vaccine. Maybe vaccines aren't available, and economic activity then slows and reduces. Europe being a prime example. So I think it was the same weekend that the UK was enjoying its first relaxation of lockdown measures. You had Germany, France, and other parts of Europe imposing, albeit relatively short periods, of higher restrictions. So it's all around about making sure we can get a decent vaccine rollout, that we can start really combating COVID, and then that allows economic activity to open. All of the stimulus put in place is to ensure that there are still things we can do and spend. All the fiscal stimulus has been made sure to make sure shops, restaurants, airlines, hotels, pubs are still open and available for us to spend our money and boost the economic activity. Now, this is really key. We are really key. Now, what we've got here, it's Goldman Sachs did a survey of the amount of savings, and basically the average American will say roughly 6% of his salary. What you saw in April 2020, because of furloughing, and we've had a very good question on furloughing, I'll cover that off in a moment, is that, you know, people were put on furlough. In the US, they were made unemployed, but given higher unemployment benefits. That's the way they tackle furloughing. And their savings increased substantially. Now, a lot of that was initially spent on bringing in new IT, people working from home, upgrading. You know, you're living in your house a lot more than you were if you're going out to work 7, 8, 9, 10 hours a day. You know, we saw a lot of furniture expenditure, a lot of DIY expenditure, a lot of IT expenditure. That was sort of done so people could either A, work from home, or B, just upgrade their own home. And we saw a lot of people in the States moving out of the big conurbations such as New York and moving down to areas such as Florida. And it'll be interesting to see if that reverses and people have to go back to their offices. But it ticked up again, because once you've bought your sofa and your IT, there's, you know, you're still going to have excess savings. And it's estimated at the moment the US consumer has 2 trillion of additional savings to be deployed. So imagine that when lockdowns are released, there's 2 trillion. Now, not all of it might go into being consumed. There might still be a higher level of residual savings, but we expect a huge amount to go into restaurants, hospitality, hotels, airlines, things we couldn't do in lockdown. So we've bought enough gadgets. This is stuff to enjoy services, holidays, restaurants, and this is where the expectation for an increase in inflation will come along. Now, why we think inflation spike will be transitory is because, you know, albeit maybe I would love to go to the restaurant every day for a week, but I'm not going to be able to do that, maintain that for months and months on end. So once the initial furore has died down, then you go back to a normal level of consumption. But this boost will flow through to the second half of the year. And it's not just the US. The Bank of England have done their own figures as well. And in the UK, there's roughly 160 billion of additional savings that could be deployed as and when lockdown finishes. So 21st of June, all the lockdown measures come down. You've got the 17th of May, where we can eat inside a restaurant, I believe, and potentially go abroad. So I'm not sure about everyone on the call, but I'm looking at some point to having a holiday. We've been asked a question about, and let me call it up so I can. Oh, let me go backwards to that one. And it was about, do we think valuations have gone up too high? So here we have the valuations from the bottom of the market, which was the 23rd of March. And you can see here the pattern, and we've grouped them into factors. You have growth and you have value. Now, the growth companies you'll all be familiar with, Apple, Amazon, Alphabet, which is Google's new name, Tesla, you know, high growth companies. And it was, if you had a digital presence, if you had viability and visibility of earnings, you absolutely flew through the roof. What changed was on the 9th of November. So this data is taken to the 6th. Monday, the 9th of November has now been called Vaccine Monday. That was when Pfizer and BioNTech announced that they have a vaccine for COVID. And it was a reversal. All of the stocks that hadn't done very well, you know, a lot of them being the income stocks, suddenly absolutely through the roof. Not to the extent of the growth of the others, but we see a massive rotation from that, and we think that's going to continue. And here we have estimates for earnings per share for all the regions of the world for equities. You can see 2021 having some eye-watering numbers. Most importantly for us, though, those numbers continue throughout 2022. So for us, 2021 has always been about this 2 halves, getting the population vaccinated and then allowing restrictions to reduce, and that pent-up demand being deployed, and making the second half of 2021 an extremely good year. Volatile, granted, but I think you'll look back on your calendar year of 2021 and be very pleased indeed. And we think that will flow through to 2022. Now, remember at the beginning I said it was about spend now and tax later. There is obviously going to be a flip side to this. And, at some point, stimulus will be reduced. Furloughing will be stopped. We had a question about furloughing. Now, we don't think that's going to cause countries to go back into recessions. It will mean certain sectors, certain companies will probably go out of business, because what this has shown, all crises tend to show cracks where there's weak business models or weak parts in the economy. The stimulus has allowed those to remain, but we think obviously when that's taken away, there'll be certain companies that will fall to the wayside. Probably there'll be a lot of more mergers and acquisitions coming through, because a lot of companies, their balance sheets will have swelled as well. But it's not all good news. We have to be cognizant of some bad news on the horizons. And I've already mentioned inflation, and that's probably the biggest risk going forward. And here you have inflation swaps, and this is sort of a derivative where people can trade future expectations of inflation. And you can see here a huge spike of inflation, pretty much from the bottom of the market we had in 2020 and going forward. And that's people's expectations that because of all of this additional stimulus, at some point it is going to generate additional inflation. Now, we expect higher inflation at some point. The central banks expect it. The US central bank even changed the way they measure inflation to a static 2% level to an average 2%. Now, why is that significant? Previously, if inflation started to go towards 2%, as a market, you would expect the central bank to react immediately when inflation hit 2%. When you're looking at an average of 2%, you expect the central bank then to allow it to go over and run hot before taking any action. And that's why we've had comments from Jerome Powell and the such like to say we won't be raising interest rates till 2023. Now, this is arguably the start of a bull market, or continuation of the previous bull market. I think we're probably okay until the end of 2022. I think towards the end of 2022 and 2023, that's when we'll have a clear understanding of what the outlook is going to be for all asset classes. Obviously, the big issue is this is predicated on COVID. Now, the issue we hope we don't have, if it mutates and the vaccines aren't successful, then obviously we're going to have lockdown measures in place longer. And obviously our base case is predicated on lockdown eventually coming off and allowing that pent-up demand to come through. Sorry, marketing forced me to put that in, so we'll quickly whiz past that one. Brilliant. There's the risk warnings, and we now have time for questions. So I'll stop sharing there and call up that second question. Thank you, Mike. Looking at investments in digital and tech sectors, do you believe there is a danger of overvaluations and the spectre of the tech bubble bursting? Really pertinent question. If you look back at the S&P 500, which is the top 500 companies in the US, 5 companies made up 25% of the capitalization of that. They took up a quarter of the returns and the weight of that. And when you get that level of concentration, it's always going to be worrying. Now, those companies were Apple, Facebook, Microsoft, Amazon, and Alphabet. Now, I could put a really good case in place for those companies still maintaining a level of dominance. They have really good business models. They have really exceptional balance sheets. They're extremely strong. They could withstand not having earnings for a year and still be in a dominant position. It's the tech companies behind them. That's the ones we worry about. So Tesla, for example, exceptionally innovative company, electric vehicles, SpaceX. But are they going to be the winners? You know, their stock price went up 700% last year. 700%. It's down roughly 20% so far this year since it joined the S&P 500. But we think, would you pay, I think it's something like, gosh, 100 times earnings for that electrical vehicle company? Or would you rather pay 10 times earnings for Volkswagen, who are equally committed to the electric vehicles, do have the distribution in place in the US and Europe, more importantly. So it's about making sure you're investing in the right places. So I think there will be some tech widows along the way, but I still think there will be some dominance of big companies. However, if you look back 10 years and see what the dominant companies were then, you were looking at energy companies and some banks. So the leaders do change. The leaders do change. One other question we had as well was regarding property, and what do we consider the future for property as an asset class when everything opens. That's an interesting one. We don't invest anymore in physical property. We do invest in property equities. So there'll be property companies rather than physical buildings, because they're too illiquid, and we don't want to be in a situation where a fund gates and you can't access the money. So we want to avoid that. But it's interesting when you hear about the managers talk about offices and retail space now having to be a lot more spacious to allow for social distancing. So I still think people want to visit shops, and I still think people want to go to work, but it'll be in a more spacious environment. So yeah, I think the sword of Damocles is hanging over property at this moment in time.
Jane, another good question that we've had is, what do you think about interest rates? Do you think that they could go negative? And if they do, what would be the impact from there?
Yeah, really good question. Obviously, we had negative interest rates in lots of parts of Europe during the global financial crisis and coming out of that. So in sort of 2012, 13 and 14, Denmark, Norway, Switzerland, a lot of the Scandinavian countries had negative interest rates. And some have only just literally come out of that and gone back to positive. The Bank of England, in their monetary report in February, mentioned that they'd done a survey, a study on the possibility of implementing negative interest rates. Now, they said they were unlikely to utilize that, but I think what they were doing was showing the markets that there was no place they weren't willing to go. And what the markets needed is reassurance that they'll do whatever it takes. So I think the probability of negative interest rates is really low, really low. It's not one of our base cases. So I think we're probably seeing interest rates as low as they're going to be. And I think very similar to the US, I think the UK will probably similarly look to raising interest rates at some point, maybe in 2023. So I think we've still got at least a couple of years of still ultra low interest rates, which will bring issues with it going forward. That's why bonds have had such a tough time, because with low interest rates and potentially higher inflation, that's not a good combination for fixed income.
Okay. You touched on earlier about the question about the furlough scheme.
Yes.
And, you know, at the end, when furlough comes to an end, will there be some people that maybe don't have a job to return to? And could that push the UK into a recession, and also worldwide, globally?
Yeah, really good question. If you look at both the Bank of England and the US Federal Reserve, one of their remits is, you know, stability of employment, which is really critical. So, you know, one of the reasons we don't think interest rates are going to rise anytime soon in the US is because not only do they want to see inflation at around 2% on average, they also want to see full employment before they even start pushing the trigger for interest rate rises. So they want to give companies reassurance that their own costs aren't going to suddenly increase, and that they can actually find a level playing field before stimulus and interest rates rise. So I think there probably will be an element of people losing their jobs, but I think it will be sort of discrete areas rather than being sort of another pandemic of unemployment. So I think the stimulus measures in place, loans in place. The government did their loan system that can be spread over 10 years. I think it's allowing companies and industries time to get back and recover from this, rather than having to make that quick decision of, look, we need to fire half of our staff. Because what the governments want around the world is more people in employment. That means more people spending, and that means more economic growth.
Brilliant. I mean, the final question we've had as well is there's talk about potentially a third wave of COVID coming later in the year. How might the stock market react to such an event?
Yeah, great question. Obviously, everyone's thinking, obviously we're almost back to where we started from, as in, March last year is when COVID sort of, first really massively hit us. Everyone's thinking, well, we had a spike in winter. Are we going to get another spike as we, get through summer? Are we going to get a spike as more people travel around the world? So at the moment, if you read all the research, we believe the vaccines can cope with these variants. It's our sort of worst case scenario, Andrew, that you do get a third wave that makes people have another lockdown. Another lockdown means progressing with more economic stimulus, and we're still in this sort of holding pattern. It'll be interesting to see. I think the summer will be a definite litmus test for how variants spike up. Is there going to be a spike in the number of cases? I've had my first jab. I don't think you and Sarah are old enough yet to have yours.
Yeah.
So it'll be interesting. It's nobody knows. Nobody knows. All I know is that when you map out the last 20 years, there's always been some really big things to be worried about. We had COVID, for this last 18 months. Before that, we had Brexit. Before that, we had China trade wars and Trump. Before that, we had China coming out of its economy. Is it going to be a hard landing and disrupt the world? Before that, we had the sovereign crisis, and before that, the global financial crisis. But all through that, you do end up getting a steady long-term return from your investment. So although it's don't get me wrong, massively important and inevitably scary, I still think if you have a long-term investment plan, you can get through these sufficiently.
Yeah, great. Well, we've got another couple of questions that have just come through.
Oh, good.
Probably taking the last one first because it links into the COVID part.
Yeah.
Could the current COVID waves in India, Brazil, and possibly others have an impact on the markets?
Yeah, I mean, the world is connected, and we've seen that through when lockdown measures came in. It was like, oh, hang on a minute, I need my widget from China, and the factories are
through
closed.
the Suez Canal.
Yeah, through the Suez Canal as well. So the world is a very connected place. So it will have an effect, but I think there's a blueprint now of how to get through it. I think if we hadn't had a vaccine, if a vaccine wasn't around, and suddenly you had Brazil and India flaring up as they are, I think it'd be a much more bigger issue. Now we've almost got a blueprint of lockdown, get people vaccinated, get the immunity, reduce lockdown. And India were probably one of the least areas hit last year. And, there was, you could see case studies going, oh my gosh, how did India avoid this, big disaster? I just think, unfortunately, there's a lag, and they're now catching the tail end of it. So not everyone is in the same place in the cycle for this pandemic. So it's serious, but I can't see it being a massive effect for the world because we've got the vaccine. Now, if the vaccine, as I said, the worst case scenario is if the vaccine proves inefficient, that will be the big concern.
Okay, well, thank you very much. One final question for you then, Shane. Neil and Claire have asked, how do you see the impact of the green agenda playing out in investments? And probably I'll just add a little bit more to that. The green agenda used to be obviously, we've been known as like ethical investments. It's now sort of being badged as ESG. It also included sort of social governance into there. And obviously it's a big theme. I know in our profession, our industry, there's a lot being written about this. There's a lot of worry about a lot of greenwashing going on.
Yeah,
funds just change their name to make them look like they're sort of relevant, but they're still the same old fund underneath. But how do you think this is going to affect investments going forward?
Great question, really good and very pertinent as well. I think if we're lucky enough to be here in 10 years and we're doing the same presentation, I don't think ethical and ESG and green will be around, because everything will have a green ESG filter to it. There won't be a thing as a non-ethical type of fund. Where we stand at the moment, and I think you've got Joe Biden to thank for this as well, because he's obviously rolling out his green agenda very quickly and sort of undoing a lot of the bad work Trump did. It's going forward, and I think you see a lot of firms, a lot of fund groups with launching both new funds and also, as you say, unfortunately, the greenwashing side of it. So there's plenty of firms out there that will have a global fund here, and then they'll launch a global ESG fund, and all they do is just put a thin film over the top and say, oh, this is how we measure for ESG, greenwashing, just trying to make it look green and capture some of that asset flow. So when we look into our funds in our ethical portfolios, we make sure there's a real dedicated commitment to making sure that clients' investments are doing good. I think COVID has helped. I think we've all seen pictures of Mumbai before COVID and after COVID, where it's smog ridden, and then there's people cycling around and the skies are blue. So we've had this experiment to see that actually this is reversible if we're committed. So I think all the countries now are committed to it. I think the sort of wave of commitment that was flowing through 2019 is still there for this, and I think it's the largest growing part of the pie. So from our point of view, we've got some funds in the portfolio that already pass ESG, and we've got a lot knocking on the door as well. For us, it's for certain ESGs, you're going to have a slightly less diversified portfolio. If you look at, there's still elements of energy companies in the portfolios, but some will some won't invest in BP or Shell because they're oil producers, but some will invest because they're big proponents of sustainable energy. So there's still a lot of work to be done on this, but I think green revolution, as it were, is here to stay, and some really interesting thematics linked to that as well.
Yeah, I think I would agree with that. There is a lot of different people opinion on what is ESG and what isn't. Yeah. Amazon is, for example, Amazon, great company on some parts, but then its packaging and its treatment of workers is another one. So yeah. I think for so many potential investments, there's such a different choice of whether it is in there or not. But I do feel in the next few years, everything will become ESG to one degree or another.
And companies are going to have to be really careful. So, if I ask someone, do you think Tesla is a sort of an ethical ESG company? I think a lot of people would say yes. Electric vehicles, great, low carbon footprint, that's amazing. But when you put Bitcoin into the balance sheet of Tesla, that suddenly raised questions, because Cambridge University have done a study on the amount of energy needed to mine Bitcoin. Now, I'm too old to understand mining a Bitcoin, but I know it involves computer programming. A lot of that's done in China, and a lot of the China power grid is still coal powered. And they worked out that the current amount of Bitcoin in circulation uses the same amount of electricity as Argentina. And you're like, wow. So if there's a significant amount of Bitcoin on Tesla's balance sheet, does that now make it not an ESG company? As you say, Andrew, everything's up for interpretation.
Brilliant. Well, thank you, Shane. I think that's an absolutely excellent presentation, and I hope everybody has really enjoyed it. I think Sarah's just got a few things that she would like to share with everybody now.
Yes, I just want to say thank you again, Shane. Really, really interesting presentation. Hope you all enjoyed it. And so it's really, really good to see from the start of last year how all the portfolios came out with positive returns. And I'm with you on the Bitcoin mining. When you started saying that, I visioned these coins underground and people going to give them up. So it's tech's all completely alien to us. So I just wanted to finish off and say thank you, everybody, for joining us this afternoon. Really hope you found it useful. I believe we've managed to get through all of your questions, but if we have missed anything that you want answering, obviously please just let us know. Drop us an email and we will try our best to come back to you and let you know. At the end of this call, when myself, Andrew and Shane go, it'll pop up with a very small feedback survey. We just wanted to ask you feedback if you found it useful. And as always, if there's anything else we can do in future that you would either like us to cover, or if you've got any ideas how we can, make it run a bit better or give you a little bit more value. Looking to the future, we obviously hope to see you all in the office very, very soon, or if not, out in one of the cafes at Boston Spa when we're popping out for lunch. And we'd love to welcome you back into the office, obviously, as soon as we can, and it's safe to do so. So really just want to say thank you very much for joining us. Look after yourselves, take care, and we hope to see you all soon. Thank you.